You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
It's great to be here.
Global markets are entering, well, a really volatile period. We're seeing this collision of major geopolitical risks and a huge slate of U.S. economic data hitting this week.
And that collision is making risk appetite decidedly fragile. You can see it in Wall Street's sharp sell-off.
Exactly. Safe haven flows are pushing into assets like the Japanese yen, and the whole equity rally is being challenged right before major tech earnings.
We'll be looking closely at the currency markets, where the U.S. dollar is slipping, and also at the complex geopolitical drivers, from new trade frictions to sanctions on Russia.
By the end of this, you'll understand the key risks facing traders right now and what catalysts will decide if this turbulence gets worse or finally settles down.
Let's unpack it.
So the opening bell really sounded the retreat, didn't it? The tone is just completely defensive. It all started with that sell-off on Wall Street.
It did. The S&P 500 pushed below a really crucial technical level.
And that's where things get really interesting.
It wasn't just a sell-off. The S&P 500 slipped below 6,700. But more importantly, it broke its 50-day moving average.
And for institutional traders, that's a huge signal.
It's a key trigger point. It suggests the short-term trend is, well, officially broken. That breach just set a really fragile tone for all global risk assets.
And you saw that fragility bleed immediately into Asia-Pacific markets.
Yeah.
Japan's Nikkei 225 fell, 3% intraday?
A dramatic fall.
What was the specific shock there? Why the sudden panic about Japan and China this morning?
Well, the panic is multifaceted. Part of it is just that global contagion from the technical break in the U.S.
Sure.
But you also have this weak tech sentiment mixed with, those lingering worries about the long-term trade relationship between Japan and China that's spooking regional investors.
But the tech sector seems to be the main stress point globally.
It is. We are right on the cusp of NVIDIA's midweek earnings.
It's amazing. The entire market is basically being held hostage by a single stock ticker.
It really is unprecedented. I mean, given NVIDIA's outsized influence on the entire AI cycle, the market is just acutely aware that one set of numbers could dictate the risk tone for the rest of the year.
So traders are just positioning for volatility.
Exactly. Not for stabilization. That fear is palpable.
Okay, speaking of positioning, let's pivot to the foreign exchange markets. They're often the earliest gauge of this kind of unease.
They are.
The U.S. dollar index has been drifting lower, slipping below that 99.50 level. Now, that's an important psychological floor, isn't it?
It is. A sustained break there signals some serious bearish momentum for the dollar index.
So why is the dollar softening right now? We have critical U.S. data coming, the ADP employment estimate, the Federal Open Market Committee minutes. This should be a time of dollar strength.
Well, it's a classic flight to safety dynamic, but it's combined with a policy surprise.
Okay.
The safe haven flows are, obviously pushing into the Japanese yen and the Swiss franc, but the surprise factor came from Federal Reserve Governor Waller.
He advocated for a 25 basis point rate cut in December, right? Citing fragility in the labor market.
You did.
But wait, didn't the market already sort of price in the possibility of dovish shifts? What was it in Waller's language that made the dollar react now?
It was the certainty and the timing. He used explicit language connecting the health of the labor market directly to the December meeting.
So he moved the timeline up.
He signaled a potential policy shift that was priced into the first quarter, moving it up a full month. And that contributed directly to the softer U.S. dollar, even if it didn't really help the equity sell-off much.
That's a crucial distinction. The dollar's reacting to dovish talk, while stocks are still hung up on valuations.
That's it. And you can see the Japanese yen confirming that safe haven demand.
Absolutely. The yen gained significant ground, pushing the dollar-yen pair back under that key 155 level.
And we saw some of that expected verbal intervention early on from Japan's finance minister, Katayama, warning about rapid foreign exchange moves.
But it didn't do much.
Not really. The decisive move lower in the pair was purely driven by global risk aversion deepening. When Wall Street sells off that sharply, money just rushes into havens like the yen. Intervention threats don't matter as much.
And what about the major European pairs, the euro and the pound? Were they driving things or just reacting?
They were mostly reactive. It just shows the dominance of a U.S. macro story right now. The euro held in a pretty narrow range.
Right.
It only really saw upward pressure late in the session when that broader U.S. dollar weakness set in. We had very little European data to influence it.
And the pound.
Similarly, the pound lifted above 1.3150, but it was solely benefiting from the dollar's general flight. The United Kingdom market is largely focused on the fiscal backdrop ahead of the budget.
Though I see traders are also watching for remarks from a Bank of England official later today.
Yes, from Dingra. That could move things.
And the Australian dollar seems completely stuck. The Reserve Bank of Australia's November minutes didn't offer much of a catalyst, did they?
No, they really just reiterated caution and data dependence. No new direction.
So, holding steady.
Pretty much. Policymakers signaled they'd hold rates steady if demand recovers, but they kept the door wide open for easing if growth weakens. So the Aussie dollar just kept drifting lower, mostly hit by that general risk-off mood.
Okay, so if currency traders are fleeing to safety, we should see that in commodities. But the oil market seems to be telling a different story. Crude is softening.
It is, despite all those geopolitical risks we've been talking about.
So why is that? Why the early softening in crude?
This is where the broader macro risk-off mood just dominates everything else. Yes, geopolitical factors do keep a risk premium embedded in the price.
Meaning it's higher than it would be otherwise.
Right. Because of tensions like the nuclear rhetoric from North Korea or the United Nations resolution on Gaza. But the immediate sentiment is defensive. And defensive sentiment translates to fears about future demand.
So traders are more worried about demand destruction than immediate supply disruptions.
That's the priority right now.
But the geopolitical angle on energy isn't just tension, it's about the effectiveness of sanctions, which is a structural supply issue. What's the impact of the U.S. Treasury's actions against Russian oil?
This is a huge long-term factor. The U.S. Treasury confirmed that sanctions on major Russian firms like Rosneft and Lukoil are proving effective.
So they are actually reducing Russian oil revenues.
They are, and pushing crude prices to multi-year lows. This provides a structural headwind for oil that sort of overlays the current defensive mood. It implies that a sustained high crude price is difficult to maintain if that sanctions architecture holds.
Okay, let's talk about the traditional safe haven, gold. If risk appetite is fragile and the dollar is slipping, shouldn't gold be firming up like the yen?
Logically, yes, it's supposed to be the ultimate hedge, but it actually traded weaker, and the reason for that is quite insightful.
Which is?
The market is currently more focused on real rate dynamics than immediate risk hedging.
Could you just briefly unpack real rate dynamics for us? It sounds a bit technical.
Of course. Think of the real rate as the return you get on a safe investment, like a treasury bill, after you account for inflation.
Anyway.
If real rates are high, then holding a non-yielding asset like gold becomes, well, less attractive. Right now, even with all the geopolitical fear, that calculation suggests holding U.S. dollar assets is still seen as safer than buying non-yielding gold.
Until the Federal Reserve definitively starts cutting rates.
Exactly. Gold faced firm resistance just above $4,050 per ounce. They are waiting for that macro confirmation.
So the data this week is more important than the tension in Gaza for gold traders. Fascinating. And on the industrial side, base metals.
Base metals saw more measured declines. Copper futures still drifted a bit lower. That whole sector is waiting for new demand catalysts, mainly from China, which remains structurally weak.
And I saw a note about Rio Tinto.
That's right, a significant corporate detail. They imposed surcharges on aluminum shipments to the U.S., but the bigger story is their plan to reduce output at their Yawin alumina refinery.
By 40% in 2026.
A huge cut. This signals a potential significant tightening in the medium-term alumina supply, which is an interesting counterpoint to all the short-term demand softness.
Okay, let's shift gears and focus on the sheer weight of this geopolitical backdrop. It feels like every region is contributing to the anxiety, starting with trade tensions between the UK and the EU.
Tensions are definitely creeping higher. It's moving beyond just rhetoric now into actual policy. The United Kingdom is actively evaluating retaliatory options.
After the European Union moved to raise steel tariffs to, what, an extraordinary 50%?
50%, and they sharply cut import quotas. This signals a return to active trade friction in a region that's been focused mostly on the Ukraine conflict. It creates a lot of uncertainty for the pound sterling down the road.
Meanwhile, the U.S. continues to signal an aggressive trade stance. I saw President Trump's comments that a foreign country approached him to renegotiate his trade agreement.
Right, though he didn't name which one. And this is where the policy mechanism gets interesting. He reiterated his plan to distribute tariff-funded, quote, dividend payments to American citizens.
Likely in mid-2026.
Yes. And what's fascinating is how deeply tariff strategy is now being woven into domestic fiscal policy. It's not just a trade tool anymore. It's a promise of a direct payment to voters.
Which makes sustained high tariffs a significant factor for global supply chains for years to come.
Absolutely.
Switching to kinetic risks, the Middle East is still a critical flashpoint. The United Nations Security Council passed that U.S.-led resolution for a stabilization force in Gaza.
It did, with Russia and China abstaining, which is notable, but the market immediately focused on Hamas's reaction.
An outright rejection.
A flat-out rejection. They called it an act of international trusteeship. This ongoing disagreement means that geopolitical uncertainty there remains extremely high, and that keeps the risk premium in oil.
And the U.S. is also deepening other defense relationships in the region.
Yes, confirming plans to sell F-35 fighter jets to Saudi Arabia, a major long-term strategic signal.
Moving north, Russia and Ukraine. There were reports of another Russian missile strike.
Sadly, yes. But the market is really focused on the policy response from Washington.
Right, we already talked about the sanctions' impact on oil revenues, which is proving to be structurally damaging for Moscow.
It is. But politically, there's also the new sanctions bill. A White House official confirmed President Trump will sign it, provided he retains decision-making authority.
So, continued high pressure on Moscow's economy, regardless of what's happening on the battlefield.
Exactly.
We've covered Europe and the Middle East. There are also unsettling tensions closer to home with U.S.-Mexico relations. This felt like a significant tail risk this week.
It absolutely unsettled markets. The implications for regional trade are profound. President Trump suggested military strikes inside Mexico to combat drug operations would be, quote, okay with me.
And added that Mexico knows where I stand.
That kind of remark is highly disruptive. Any perceived instability on the border has immediate consequences for manufacturing, logistics, you name it. It just adds another layer of complexity.
And finally, Asia. North Korea is injecting serious nuclear escalation risk into one of the world's most critical manufacturing hubs.
They warned that South Korea's new nuclear-powered submarine plans could justify Pyongyang arming itself with more nuclear weapons.
Which is a direct response to the U.S. and South Korea affirming those plans.
Right. It injects serious nuclear rhetoric back into the regional security discussion. It moves the conversation from conventional rivalry into potential strategic escalation, and that keeps investors intensely on edge.
So connecting all these threads, equity fragility, safe haven flows, commodity softening, and these geopolitical risks everywhere, what are the immediate catalysts we absolutely must watch?
The focus is squarely on the U.S. macro calendar. We have the ADP employment estimate, which gives us a strong preview of the labor market.
And then the Federal Open Market Committee minutes,
which reveal the inner workings of the Federal Reserve's policy discussions. If those minutes strike a less dovish tone than Governor Waller's comments, well, you could see the dollar reverse its recent losses violently.
Of course, the elephant in the room, NVIDIA earnings.
That is the single most important micro-catalyst with macro implications. If NVIDIA disappoints, given its massive influence, we could see a deeper, more profound risk-off episode across all assets.
But a strong beat could provide a desperately needed anchor.
It could. The coming days are absolutely critical. That's a wrap on our market focus for today, covering the confluence of risks hitting the global landscape.
Thanks for being here and tuning into the Financial Source podcast. We appreciate your engagement, and we'll catch you in the next one.